Good afternoon. My name is Jason Allen. I'm a realtor based in Palm Springs, California. And each week I like to focus on one of the four cities that I tend to do most of my business in. This week I'm focused on Rancho, Mirage. Now, we're late spring, so temperatures are rising. I have my Keller Williams Labs t-shirt on. It's a little more casual than I might normally come to you as. But I'm going to share my screens and we're going to look at the new housing report. So this is data for the month of May 2024. Plus I've taken the liberty of adding two extra charts. So let's dive into it. The Desert Housing Report is produced by the two associations we have here, Greater Palm Springs Realtors, California Desert Association of Realtors. I belong to this one. Doesn't matter a lot to you. In other words, it's somewhat transparent. Just know that we have two organizations that represent realtors here. They come together so that our data is as complete as can possibly be. And this comes out first week or so of a month, and it reflects sales that have happened through the previous month. So we're in June 10th, as I said, and we're going to look at those numbers. So first of all, once again, we're on Rancho Mirage. Rancho Mirage is two towns to the east and a little bit to the south of us. Here's Palm Springs, the giant green that's known internationally. Cathedral City's immediately to our east. Rancho Mirage is here. And to get your bearings, along here is the Highway 111. Over here is the Highway 10. This direction is Los Angeles. Going that way is Los Angeles. Going over here, you go to Phoenix. And for those that are wondering, this big dot here, later I started to use a star. It just tells me which of the many charts we have available to us we're going to focus on. So we'll start with the sales recovery chart. Essentially what this is doing is tracking if our baseline is here at 0. During COVID, we went way above baseline with the number and quantity and volume of sales. And then since COVID has essentially ended for all practical purposes, although it's still circulating in some communities, we are seeing where we took a big dip and now we're slowly moving up. I want to point out this 20.2 number is actually higher than it was last month. Not significantly, we were at 19, like 0.5 or something. So we're still performing under normal sales. I'm going to say some of that has to do with interest rates. I have another theory as we get towards the end. I'll talk about that. So I'm going to skip through these. You certainly can always pause your video on YouTube. If there's something about the pages that I scroll past that you want to talk about, just reach out to me. So we have Coachella Valley median detached home prices. This is a 22-year chart. This is for the detached. So this is a single family home, may or may not be in an HOA. We have right after that, we go to the attached. And with this chart, we're saying throughout the entire valley, where do we stand today versus a year ago in our median home price in that category? And the median is the house right in the middle. So half of the house is sold above that, half of the house is sold below that. And if we look at the median, we can see a year ago it was 685, today it's at 710. 710, bigger number than 685. We're headed in the right direction if you are a homeowner trying to sell your property. And if you look at it over 22 years, and why do we pick 22 years? This is just going back to pre-housing run-up of the bubble that crashed in 08. We saw the effects going through 9, 10, and then it bounced along. But if you bought your house anywhere between January of 09 and we'll say January of 24, you're probably in a better position because this is higher, just based on median. And then if we slip down into the attached, that's your condominiums, the townhouses, things with an attached wall, two or more units attached to each other. Likewise, if we look at the median over the long haul, 485 last year, 494. 494 is a higher number. Now, Coachella Valley, if we go all the way back up to the top and we look at this, we're talking about a whole bunch of cities. When we start to drill down into specific communities, the numbers can look a little bit differently. Or if we look at price points, things can look a little differently. Let me go back to where I was. So this was the last chart that we looked at I'm going to jump to this. So this says, instead of median, let's now look at averages. And we're going to break it into detached homes versus attached homes. An average, once again, is taking the total number of properties, adding all of their sales volume up, dividing it by the number of homes that sold, and we get the average. So in Rancho Mirage, California, the average size home is 3,175 square feet, and its sales price per square foot, $140.72 for an overall home price of $1,399,270. A year ago, it was $1,328,452. So the 12-month change is 5.3%. And if we take it in relationship to the historical low, we're at 176.4% increase in value. If we look at the attached, these are condominiums, townhouses, that sort of thing. Average size, 1,775 square feet. Average price per square foot currently $336.42 for an average of $597,146. A year ago, $609,198. So that's a decrease in value year over year of 2%. Compared to the historical low, though, those homes are still up 183%. So has it bounced around a little bit? Yes. If you bought a long time ago, or even in the recent past, are you so bad off? No. 163% increase in value over 22 years. That's actually really good. Or actually even less than that because it's the historical low. All right, let me skip down to our next chart. I'm gonna scroll through these. You can look at them if you want some attention paid to them, just let me know. Now, this is the home sales by city. So we're gonna, again, focus on Rancho Mirage, and we average these over 3 months. So units per month, 74 a year ago, 74 this year, 75 a year ago, roughly the same. Actually, if you look, kind of glance across the entire chart, not significantly different sales volume. Sales by price bracket. Now, I'm drawing your attention to this. This is valley-wide, and this will be important in another chart I'm going to show you. We're seeing gains in the 600 to 699 price point, 600,000 to 699,000. And we're seeing gains in values over $1 million. Now, what do I mean by that? The number of properties sold in those two brackets has increased dramatically. Again, the economy is a tale of two worlds, and we'll talk a little bit about that. But this is significant. This is particularly significant to me. And it has relevance on these other price points, which I want to talk about. Let's skip down now to dollar sales by city and Rancho Mirage. This is millions. So 93 million last month. Last month versus a year ago was 89 million. Some of that has to do with the fact that the houses just cost more, and that's true across the board. But it also speaks to more houses are selling there. Desert Housing Report, we go to the sales by price bracket, and this is just staggering to me. It's staggering, but we'll talk about it. These little teasers, unintentional teasers in some ways. So we're down here too. This is what I wanted to draw your attention to on this page. The Coachella Valley total inventory. On June 1, Valley inventory was 2,610 units. Again, throughout the entire valley, which is the highest number in 4 years. While inventory has improved, this number continues to be 1,000 units under what was normal before the pandemic. The seasonal pattern now suggests that inventory will begin to decline as we enter the summer months. That doesn't mean sales go down, just means we have fewer homes to choose from. And the key is going to be how much it will decline. I agree with all of that. The issue is that as we have more inventory, more pressure on prices to go down. As we have less inventory, more pressure on prices to go up. assuming the demand hasn't changed. In Rancho Mirage, the inventory by city you can see has increased in compared to a year ago. Not a surprise. More people want to sell their house. That's true across the valley. I don't see any city. Coachella at 21 and 21 a year ago, not significantly changed there. And then inventory by price bracket, we're seeing a lot of increased inventory at the higher end. Now, that is in this the low 1 million isn't that surprising, because you got to figure over the last 5 years, what was in the 7, 8, and 9 has bumped into that price bracket. But that sales continue in those price brackets is what is remarkable to me. And then if we look at the months of sales ratio, we're at about 4.2. So essentially valley-wide. Again, I don't like to rely on valley-wide charts, but it does sort of speak to the overall health of what's going on. 4.2, that means if no additional inventory came on, it would take a little over 4 months for us to absorb or sell every single house that's available. This doesn't help you if you live in, I'm going to say, Demuth Park, Palm Springs, because, what does that mean for Palm Springs? Or what does it mean for my neighborhood? How quickly your house is absorbing? That's detailed information I can pull based on your specific location. And then months of sale by city, Rancho Mirage 3.7. And that was this year. A year ago was 2.6. And let's see, do I have anything else here that I wanted to show you? Yes. So if we go, this is median days in market. Again, the median, the one in the middle. Basically, Rancho Mirage has the highest currently at 51 days. What does that mean? From start when you first launch your house until it goes into contract, you're at about 51 days. That's more than what it's been. It's not as few as Coachella, but remember, there are only 21 sales in Coachella. Much smaller market. Is that terrible? No. It just means that you don't, as the seller, have the opportunity to plan your next move as easily. If you're dependent upon closing on your house or knowing when you're going to close on your house here to move somewhere else, or here to somewhere else in the valley even. And then that's median days based on price bracket. Again, if you look across this 44 to 51, less than 2 months, but close to 2 months. And what's fascinating about that is many sellers, well, days on market creates a very odd dynamic. In other words, many sellers, there's a lot of work to get the property launched, and then it feels like crickets if it's not selling. And we go a week, a 2 week, 3 week, 4 week. We look at whether there should be a price adjustment. Has the market spoken to you, Mr. and Miss Seller, saying we don't like your house at this price? Or because the median, or maybe the average, which depending on what chart we're looking at, is that it's twice those number of days before we go into contract, well, we have to say maybe it's just not time yet. So again, we evaluate that on a case-by-case basis. Now, here's second to last chart. I'm gonna come back to, well, actually I can use both of these because they speak to the price discount or price premium that buyers are paying in the market. Now, this is Coachella Valley average. Long and short of it is you're seeing 2.5% knocking off the price on average. There was a time when we were going way into the premium mode, right? We all remember that. It was in the media all over the place. And then we look at Rancho Mirage specifically. On average, this one by average, they're taking 3.5% off. Okay, that's the average. And then we look at this chart by price, and again, you're running anywhere from 1.4 at the low to 3.8 when you get up into the millions. And yet, there are a percentage of homes that are selling over. This 15.3 has not changed dramatically. There was obviously, here it was when it was in COVID time. 16.8 was sort of the last high water mark prior or post pandemic. But those are valley wide. Now, that's the last page in there. Here's what's deceiving and where there's a disconnect in the marketplace. I'm going to show you for Rancho Mirage 2 reports I ran. I have to switch screens. So this first one is for statistics for Rancho Mirage houses. And let me just tell you that the tools agents have in our respective associations are not as robust as what brokers have or and they're not actually that sophisticated. They have a few more options, but compared to what the associations themselves can run, and this is what they give us, we don't get to go and ask for our own custom report. So we sort of have to go back into our MLS and cobble together some things. It occurred to me that I can look at houses that sold in Rancho Mirage, and then I can look at condos. So I'll show you the condos in a moment. If I can see that 535 houses, single family dwellings sold in Rancho Mirage, how many of those had a price change? Well, that's right over here. 211 of them. That's 39.4% of the houses that were sold in Rancho Mirage had a price change. Price change, not a reflection of the price premium. So if we go back to the other chart where it was valley-wide, anywhere between 1.4% and 3.6%, I think it was, the average, and then that factors in any price premiums that were paid to get to those numbers. It belies the appearance to the average consumer who sees closer to this statistic, not in a statistical form, but if, let's say, I am a consumer and if I am searching for $900,000 houses in a market, and I do this through an agent who's giving me a direct feed to the MLS, like me, or just going down to Zillow or Redfin, and you're getting ticklers, you're getting an email daily or every few days saying, here are the new houses, or here's a price change. For almost 40% of the houses in that Rancho Mirage category last month would have come in as a price change. And we don't see prices going up very often. As a price adjustment upward, we may see it close higher, but we're seeing price reduction. It's the counterbalance or the analogy. And I want to just quickly show you here's condos, similar, 37.8%. So 309 condos sold, 117 had price changes, presumably price reductions. This, in my opinion, and I'm no economist, but I read the newspaper, all the statistics that the government presents shows our economy is the envy of the world. We have other countries have higher inflation and fewer job creation and all sorts of economic turmoil. That's not our problem. We have higher inflation, which the government is working to address. We have higher interest rates, which the government is trying to address, in part trying to use the interest rate hammer to pound down inflation. And the only way that's going to happen, that we're going to get a rate reduction in mortgages, is when we see housing start to stall a little bit. But when we look at the overall health of the market, when we start to go to averages and we start to zoom out, we can begin to see year over year, the median is higher in both houses and in condos, or detached and attached. We can see that on average, there are 15% of the properties that are going over. We can see on average that price reductions are about 1 to 3%, 1.5 to 4%. But that's not the impression the average buyer gets when you get that tickler and all you're seeing is price reduction. So, are the price reductions dramatic? Not necessarily. Sellers could just be inching their way down. So we get the whole number of the, whatever it was, 117 or 211. but we're not seeing percentages. And even if we did, all we would be seeing are averages. So this is where we go to, for example, I had someone contact me just the other day. They'd like to sell their condo in a multi-story building. And we can very easily isolate that building and say, how much are condos like you're selling for? How many of them are taking a price reduction? How many of them are getting, when they close, more than what was asked? How does your home compare to those homes? So we have to get granular when it comes to individual purchase opportunities on a buyer side or a seller situation who wants to sell their home. Now, when I go back to the chart and I see where homes over $1 million and over $2 million in those price ranges are selling like hotcakes, even though the inventory is increasing, it tells me that wealthy people recognize this is a buying window. Clearly, people in that price range aren't quite as strapped as someone buying in the $400,000 range. So if they're wrong by $100,000 or $200,000, let's say 5 to 10%, might not hurt them as much as someone at the $400,000, $500,000, $600,000 mark. But here's what I know. I've done this business a long time. I'm in my 17th year. That real estate markets go in cycles. We are right now in a cycle with downward pressure on prices after historic run-ups, but it's somewhat of a downward pressure. And we have a challenging buying environment. Add to that the absolute and utter ground-shaking uniqueness of the National Association of Realtors settlement of multiple lawsuits around quote-unquote price fixing, and there are a whole bunch of buyers on the sidelines waiting to see how the dust settles. And when you factor in the presidential election that will happen in November, anybody that's paying attention, regardless of what side of the aisle you sit on, is nervous, is wondering how it's going to turn out. But this is what I also know. Come November 8th, 7th, whatever voting day is, the day after that, one side is going to be very happy. And those people are all going to rush out and buy houses. Maybe not all of them, but you get my point. A lot of uncertainty in the market. I don't see any fundamental reason we would see housing prices crash. Why do I say that? We have an economy that is the envy of the world. Now, could your personal finances crash because you'd lose your job? Maybe, I don't know. But if your job is stable or you're on pensions and retirements and you have a steady income, don't wait. Do not wait. Even if between now and November prices go down somewhat, we won't know until after they've started to go up again. And so take, for example, the fixer that I have. This is a phenomenon in the marketplace. Nobody wants fixers, it seems like. If a house so much as needs a new roof or air conditioning, hello, it's a house, it's going to need maintenance. People are walking away. Or they're making ridiculous lowball offers that a seller would never take because it would be cheaper for them to simply do the work themselves. My point is, buyers are becoming extraordinarily choosy. Great. Be sure you understand the value proposition in the broader context. Broader context. It's a little bit like, do we have a cold or do we have COVID? Can I reasonably afford this property and be okay with one just like it next door coming on and selling for 1% or 2% less when I know I got a good value on a house I really like or a home I really like? Because in a year from now, 2 years from now, 3 years from now, 4 years from now, on average, people keep their house about 7 years. In 7 years is the value that I have built because I bought when I did. Does that outstrip the 2 or 3% that I might have gotten if I had gotten lucky and gotten that house And who's to say I would have been that convinced to buy that house when it was on the market if I hadn't bought the one that I was in? Owning a home, first, second, third, whatever house it is a lot like planting a tree. Your best time to do it is yesterday. So that's my take on it. When we start to see the houses at the real high end slow down a bit, it's probably because they realize the best values have been purchased at their price range. And now as people start coming back into the market when interest rates go down, prices are all going up. That's all I got. You're always welcome to reach out to me. I'm happy to have one-on-one conversations or do a quick pricing analysis. I will say, and I've promised this before, we do have big changes based on the NAR settlement. I don't think they're bad. They're just going to be different in how we operate and how we do business. And ultimately, I think the consumer is going to benefit, whether you have lower commissions that anyone is paying or not. You're simply going to be more informed. It's going to be a requirement that those of us in my role educate their clients more. Have a wonderful week.